Welcome to the Daily Update, where I'll go over the action in the market for Tuesday, May 7th, and then we'll see how things look for Wednesday, May 8th. It was a pretty sleepy day. The market had already been looking kind of tired. We had that gap higher and strong close on Friday. We had another up day on Monday. We've been going up a little fast, so to see the market kind of take a breather is not necessarily a surprise, but at the same time, we want to keep an eye on things. If we start to see some selling into strength, which we're not really seeing to this point, we want to try to evaluate what that selling is looking like. We hit overhead resistance at the 5,200 level for the S&P, and we bounced down from that. That's a nice round number. So we'll be keeping an eye on that. We did have a slight up day, so it helped some of our indicators to click over a little bit more positive. But as always, there are some things that we need to be aware of. First of all, let's go back and talk about what happened, and then I'll go through the charts. Right at the open, we had a gap higher open, and prices hit R1. A lot of the gains that we're seeing are not necessarily coming in the cash session. They're coming from the futures, and then we gap higher, and we're able to maintain those gains. And so that's really helping things along the way, but we're not seeing an awful lot of movement intraday. At least we didn't in Tuesday's session. We did hit R1 at 51.44. As the day went on, prices chopped along R1. We did hit resistance at 5,200. Then we declined. It's like that's what brought in some selling at that point. We're going to be watching for something like that in Wednesday's session. And then we declined all the way down to the unchanged level. That is a built-in support level on an up day. But then we bounced up a bit from that to close below R1. We were up 0.13%, not a gain, but still a positive day. We're below average. So we've seen 2 days now with below average volume. Not an awful lot of conviction in the cash session itself. We're positive in the short, intermediate, and long term. We never did go negative in the long term. It was the short and intermediate term where things have been switching as we were pulling back. And it's about inflation and interest rates. And we're also dealing with earnings. A lot of companies are coming out, and that can have an impact, especially the bigger companies that can set the tone for not only a sector, but an entire index. And we want to keep an eye on the geopolitical things. Things might be getting a bit more tense in Israel and Gaza. There was talk of a ceasefire that ended up not really coming through. We'll see if that leads to anything more. And we don't know if that's going to actually have an impact on oil or on gold or on the dollar or on stocks. So we want to be aware of that situation as well. Some comments. It was a mixed day. Mega caps underperformed. There was a bit of profit taking after a couple of good up days. And small caps had another good day. They've not broken out of that range yet, but they did better on a relative basis. On a short-term basis, we still have our list. The Stochc RSI, Williams Percent R, CCI 14 and 20, and the stochastics. These are the usual indicators that when we're going up or down tend to get extreme first. Now, this could suggest that they're extreme positive and due for a pullback. On the other hand, it could suggest that as long as this list stays kind of long the way it is now, that it's good momentum at the same time. We do have a new intermediate term indicator, and I usually use this in the intermediate term. You might be able to say it's more short term. The CMB composite is looking extreme positive. We're still extreme positive with the 150 and 200. Again, 2 ways to look at that: overextended to the upside or showing good momentum. And I've been neglecting to mention something here that came out of the Fed meeting last week, which is really quite important and a big reason why the market's going up. But when we look at the scenario, it's likely that the Fed's going to leave rates unchanged because inflation is kind of stalled at coming down. And in fact, it's starting to go back up. We're hearing that word stagflation being thrown around. We don't know if we're going to develop into something like that or not. We just want to keep an eye on things. And this is what's really giving a lot of strength to the market, that the Fed is decreasing. It's not necessarily official, and it kind of came in sideways, but quantitative tapering. That's when they're actively decreasing their balance sheet. And so instead of doing that, they might actually go in and do some buying. They might not try to cut back on the balance sheet as much. And the market is taking that as positive. The dollar was down. It's up in after hours trading, and interest rates were also lower. We closed at 4.46%, where we had been at 4.49% with the 10-year yield. We're still inverted with the yield curves, and I don't know what's going on with this. We had another up day. We had an up day on Monday, and it's like the CNN money gauge is here. It went down on an up day, and it didn't really go up after Monday's session. Not sure really what to think of that, but it's still giving us a negative reading for the time being. Our trend is now positive. The green line has crossed above the red line. We're still in a weakening trend. We've not been able to cross above the moving average yet with the ADX, but we're still above 20, at least in the intermediate term. Because we had another up day, our bias is positive, and the last number of days have now switched over to looking more positive, so that's where we show our momentum. Economic reports. We just had consumer credit, and this is came in less than expected. It did increase by 6.3 billion. A lot of folks are having to live off credit right now just to get by, where they had expected 15.3 billion. So yeah, a lot more people are getting into debt, but it's less than what they thought. Last time we did come in at 15 billion increasing in debt. And I don't show a chart of that. I just go through the numbers on that one. So some Isabel Net blog charts. This is looking at where we're at with the S&P and the earnings per share. This is put out by Goldman Sachs, where they have us around the 5,200 level. That's what they're estimating by the end of 2024. Right now, we're actually above that currently, but they're projecting the earnings going up, and that is ultimately what drives stock prices. And so as long as this keeps going up, that gives room for the market to continue to go up as well. And then this is becoming a little more popular than it used to be, where companies now have a blackout period before they release their earnings. And this just shows all the companies that are in blackout. You notice when we started to run into trouble was when a lot of the companies that are possibly buying back their own shares, they can't do that because they're in a blackout period until after their earnings come out. And this is actually a couple of days ago now, but we're getting into a time when that blackout period is starting to go away. And so some of those companies that have announced buybacks, they may come in and start to do some more business and buying stocks, and that could also be helping the market. And then risk appetite inflows after adjusting for cyclical growth. Just this is kind of a weird way. It just shows that the risk appetite has been rising above the zero level, which is average, and it still has room to go up. If you base this around what has happened other times, when we get up to this 2% level, that's when we're starting to get extreme. So we just kind of go with this in the meantime, as folks are willing to take more risk, especially if things turn more positive in the stock market. Then look at markets pricing in less cuts than the Fed. Dot plot in 2024. They had been forecasting more interest rate cuts, but now that's starting to come down quite a bit. And we've been talking about that in these videos, and it's been pretty prevalent coming out right now. And then what are the S&P 500 returns during earnings season? We're actually coming down. Now, this is as of a few days ago. It's not necessarily figuring in the bounce that we've been seeing since late last week and so far this week. But after earnings have been coming in, the results had been negative up to this point. And then the MOVE index, which is something that I go through mostly in the intermarket analysis update over the weekend. It is starting to drop as bond prices are going up and interest rates have been coming down. Nothing really of interest other than here's the cycles chart that we have. And again, I'm just trying to evaluate if there's even anything to this. It hasn't been updated in a while. I go to this gentleman's YouTube channel. There's no new video there. And so I'm just kind of watching this to see if there's something to it. We could still be in this upward cycle period of time for right now, but this is kind of a concern. Apparently, Jim Cramer came out and said that the sell-off may be over. Now, this guy's really good at being a contrarian indicator. So if he thinks that things are over, they it may not be over. So we'll just have to see. And those of you that have been watching the videos for a while, you know that I don't really, he's probably a nice guy, but what he's trying to do and be more of an entertainer rather than an educator, I don't really have a high opinion of him. And I never watch his show. All right, intraday, we did gap higher, and that's where most of the gains came from initially. We got right up to R1, and then we just chopped sideways. You can see how the market's just not really moving a lot intraday. We did just dance along R1 a little bit above it. This is when we tried to break out, but we hit 5,200, and then that triggered some selling that came in, and that dropped us all the way back down to the unchanged level, but then we bounced up off of that going into the close. Intraday, nothing really too earth-shattering. We were looking fairly good with the futures that carried over into the cash session. That carried over into the European session, which then carried over into the cash session, and we're down just a few ticks as I started to record this. Intraday, we're still seeing where growth is outperforming value, so that's still holding up for the time being. But we did decline a little bit here with our growth to value ratio for the S&P intraday. And then end of day, we were down with growth where we were up with value. Mid caps had growth outperforming value, and small caps, the growth actually outperformed a declining value for the day. So we're coming back up with small cap growth to value, but not really showing any real convicted strength at this point. We actually ticked down with the mega caps, and we turned down just slightly with S&P growth to value. So we want to see these going up if we're going to turn back more positive on things and stay there. We came down just a little bit with these two ETFs comparing growth versus value, where we came right up to the top of the rainbow. Now, is that going to provide overhead resistance? The bottom end provided support, and we bounced up off of that. Are we going to run into some problems here? Not saying that's what's going to happen. We just want to watch for that. Discretionary to staples, looking at the bottom area of all these different charts, we did decline, but we're still above the 200-day moving average with this ratio. Large cap growth, it was virtually unchanged, but it was down slightly, 0.04%, as it ticked down just a little bit, but it's still above its 50-day moving average. The Wilshire was up a little bit and has been able to get above its 50-day moving average. That's a broad market measure. Keeping an eye on our trend where the green line is above the red line, but the ADX continues to decline. We're just barely above 20 right now, and we're below the moving average, where we're already crossing below 20 with the short-term ADX. However, we are positive now. We want to see this trend turn and start to go stronger for it to show that there's more conviction. And as long as the green line stays on top, that would be a positive trend. We did come down. We've seen a couple of days now with below average volume and sentiment. Apparently it was the Ulcer Index chart. If you've watched these videos the last couple of days, I would hit a button and then there would be a blank spot. Let's hope that I found it. It was the Ulcer Index, which has been coming down. And we're dropping off here with the VIX on the line chart as well as the bar chart. But we actually ticked up just a little bit with the VIX of the VIX. We're getting really, really low readings here. And that might be slowing the VIX down. Well, it's ticking back up a little bit. And this is just a little warning area that we want to keep an eye on. When we get really low readings like this, then that generally means we've bottomed out as far as volatility decreasing. When this starts going back up, that means the volatility is now increasing. The momentum of the VIX continues to be down. And we were up just a little bit with the equity put call ratio. We're still going up with the 5 period. So that's more the negative side of things. But we use other things than just this. This is not necessarily confirming what we're seeing in other charts at the present time, but we still want to keep an eye on this. We're really coming down still with the volatility risk premium, as there's just not a lot of fear in the market currently here this way. We ticked up a little bit with this fear gauge, where we're continuing to go down slightly with our other fear gauge. We're holding up fairly well with the advanced decline line based on price and volume. They're both continuing to advance. This has been one of the more positive areas that I've seen. We saw a real expansion of the new highs and virtually no new lows. So we're still going up with the 5 period and the 10 period. So this is an internal measure that continues to hang in there. And we're looking better with the advanced decline ratio. Both lines are above 0. That's positive. And we actually were flat to slightly declining with accumulation distribution. However, we're still above the moving average. But the Chaikin money flow has now ticked back down and is looking a little more negative. It had turned positive after Monday. Now we're turning a little more negative after Tuesday. Chaikin oscillator still positive, and we're looking okay with the cumulative advanced decline line for the NYSE. And our regular advanced decline line is now breaking out and showing some improvement. This other NYSE advanced decline line also showing some improvement here. The NYSE common stock based on the advanced decline line on the top up here, it should be based on price up here. And we're also looking better here based on volume. We're looking okay with the NYSE new highs minus the new lows. We're still positive. The S&P advanced decline line based on price is still going up as well as volume. And we're still hanging in there with the advanced decline line studies. NYSE common stock, the S&P, the mid caps, and the small caps, not really breaking out, showing any real strength, but still hanging in there and above their moving averages. So here's our short-term chart. We have some resistance just above the 5,200 level for the S&P. And then if we do fall, we'll be watching that 50-period moving average. On the bottom, you see where we continue to be below average with volume. The Stochk RSI is still extreme positive. Here's the Williams percent R, the CCI 14, and the CCI 20. These are our usual suspects here. We want to keep an eye on the 20-period simple and exponential moving averages. We're above them, and we're starting to turn back up, and that's positive. This is generally considered the short term, and as long as we stay above that, that's still showing some improvement. And we're looking better with our double and triple exponential moving averages based on 20 periods. They are turning up in prices above both of the lines. We're continuing to go up with our 20, 50, and 200 period moving average studies. We declined a little bit. We're no longer extreme with the force index. I didn't put that on the list yesterday, but now I didn't need to put it on the list because we came down a bit from the Keltner band. We're looking extreme in the short-term stochastics, intermediate-term stochastics. We're trying to cross above the midpoint with our longer-term stochastics, but all of these are showing a lot of improvement and positive. We're still in the +2 channel with our standard deviations chart. Intermediate term, the balance of power is now turned back to positive. We have these brown bars here with the go, no-go system after they had been purple, so it's turning more positive. We're above the highest high value, and now the blue line is starting to turn back up, and the midpoint is starting to turn back up. So that's showing an improvement there. The TTM squeeze has now turned positive. In our 50-period double and triple exponential moving average, we're still above both of these lines, and the lines are starting to turn back up. Here's the CMB composite. Now, I always want to warn you with this. I put these black lines on here. There's nothing magical about them. I just kind of eyeball it and say, okay, that's a pretty good spot to put this. And that's where I put the line. And so sometimes when we get to a reading like this, that can suggest that we're looking extreme positive. Here's the 50 period. We're above both the simple and exponential moving averages. If we start to fall, we'll be waiting to see if one of those provides support. The ease of movement is above zero and advancing, so that's now turned positive as well. The Arun is starting to turn up. It's still negative for right now, but at some point it's going to figure out what has been going on and probably really spike more positive. The S&P McClellan oscillator above zero and advancing and not necessarily extreme yet. So this is still hanging in there. So our summation index based on price and volume crossed above zero. So this is showing a lot of improvement as well. We ticked down just a little bit with the NYSE McClellan oscillator, but we're still above zero. So the summation index for the NYSE is going up based on price and volume. The Swenlin trading oscillator continues to advance based on price and volume as well. And we're finally starting to see a little bit more positive action with our oscillators. The PMO's finally crossed above its moving average. Now it's still below this red line, but turning up. It didn't get a real extreme reading, and this would suggest that this is more of a pullback. When we get down to these really low readings, that's when we're really screaming to the downside. So this is looking a lot better on a momentum basis. We're also looking better when we break it out based on price and volume. And we're going up with the PMOs that are rising. The buy signals are going up, and we're ever so slightly starting to turn up with the PMOs above zero. Again, as I mentioned yesterday, a lot of the repairing that's been going on with these oscillators inside of the S&P has been happening below the zero line. And that's why we're flattening out with this. And if they start to actually go positive, that's when we'll see this indicator start to go up. We are positive with the Elder's Impulse system for the S&P. We're positive with the parabolic SAR. The slope is now actually positive. It's crossed above the midpoint and it's above the moving average. The MACD is getting just barely positive now, so it's looking a lot better. So all of our oscillators, the short term, we're now back to positive. Intermediate term, we're crossing over and looking positive. We have a little ways to go with the tricks. We haven't quite crossed the moving average, but we have crossed the moving average with the KST. And here's our moving average spaghetti tree here. We're above all of the plotted moving averages. The longer we can stay above them, the more these lines will turn up and the more positive it will look. If we see some weakness, we're going to be watching these different moving average levels to see if they provide support. The bullish percent index is above 50 and advancing. That is positive. The NYSE bullish percent index is also above 50 and advancing. The NASDAQ 100 bullish percent index is still below 50, but it is advancing. Again, as I've been pointing out, some folks call this positive once we go back above 30. I wait until we get back above 50. The money flow is positive. We tick down with the ultimate oscillator, but we're still above 50. The vortex is now turned over positive. The RSI based on 14 and 9 periods, those are now above 50 and showing an improvement and positive. On balance volume continues to go above the moving average. That's turning positive. And the stocks in the S&P above their 20-period moving averages, above 50 and advancing. So the short term is really improving. Here's another look at the short term. We haven't come up to this 70 level yet, so we haven't seen that real big thrust up. So we're just waiting to see if that will happen. Now, what happened last October was we saw a thrust up similar, not looking at the price, but looking at the chart, to what we're seeing now. And this ended up failing, coming down, but it ended up producing a positive divergence that after that was when price really started to shoot up. That's what we're going to be watching to see if things unfold. If we see some weakness over the next few days and this starts to come back down, will it get down to the point where it sets a higher low if something like that happens, and then we see a thrust up out of that? Again, I don't know if it's going to play out that way, just something that we're watching to see. The 50 period did climb above 50, and so that's actually turning more positive. The 100 is looking better, and the 200 is looking better. The Copic curve is positive. The Sean trend meter getting up to the upper end of this green level. We could start going into an even more positive area. When we get above the red line and then definitely above the blue line, that's when we're starting to look extreme positive. The Ichimoku cloud, we're just still right at the upper end of this cloud. We really haven't broken out of it yet. The Pring bottom fisher does look like it gave us, at least to this point, a pretty valid buy signal. And the mass index is now above the blue line. We're waiting to see what will happen when we cross back down below the red dashed line. We are positive with the Heiken Ashi chart, positive with the Kegi chart, positive with the Renko, and positive with the 3-line break. We had another new X drawn in when we darted up to 5,200. That was enough to put another X in the point and figure chart. But we don't have a signal or a pattern that's actually being signaled yet. It's just showing an improvement for the time being. Excuse me. Long term, we're still above this R1 level. And if we break out above this, I'll stop showing this chart. I'm kind of sick of this chart, to be quite honest. I've been looking at it and talking about it for months. But if we see some more weakness, we have to see if this level, the 5110 to 5111 level, if that ends up providing support. We're still looking extreme with the 150 and 200. Again, this could show good momentum. We're positive across the board with the Keller market model. We're switching back to positive based on price with bonds in the short term, where they're still negative in the intermediate to long term, but everything else is looking more positive. The dollar was up enough to switch back to a positive uptrend in the short term. We did see a change here with the trend models, and I don't know why. This should be up in the PMO is crossing over. So this should be an up arrow as well, a green arrow, where we have now switched over to positive with the trend model. This is the decision point scorecard. So this is showing some improvement here. We saw all green or blue along the way in Tuesday's session. So a lot of damage that had been done is slowly but surely being repaired, but we're seeing that more on a broad market basis right now. And then I want to include this. I don't know if you'll find this helpful or not. This is just a daily version of the different sectors. There are 11 sectors that make up the S&P, and I cover these more in the intermarket analysis and the weekly videos and so forth. I think maybe it will help if we just kind of keep an eye on this on a daily basis. Where discretionary, this was down. This is one of the areas that we want to see doing better. Tech ended up being down. That's another growth area that we want to see doing better, where we had things like materials, utilities, and staples. Now, materials, they can be more when the economy's doing better. Utilities have been seeing a real bounce lately. Staples is more defensive, and it's in an uptrend. But these are the things that you have to have no matter what's going on in the economy. We want discretionary to be outperforming staples, and that's not what's really happening. Even real estate saw a little bit of love in Tuesday's session. Where healthcare, that's more defensive. The financial, we've been keeping an eye on. Industrials and communication, this has been one of the stronger areas. Energy has been rather weak lately. So we'll see if this helps us. I typically like to look at these in a bigger picture. We'll see if looking at it daily will be beneficial to you. So comparing the equal weight with the S&P, they're both showing some improvement here. We were down just a little bit as the mega cap slightly underperformed the rest of the market. The Dow is still above its 50-day moving average, and we're going to see this as we go through some more charts. This is not necessarily a real friendly looking bar here. To open, go up to the high, and then close right near the bottom there. That's not a good looking formation from a bar standpoint. Or the diamonds, though, they still continue to be positive. The NASDAQ also broke above this R1 level, but then closed down below it, still above its 50-day moving average. NASDAQ 100 has not got up to this R1 level yet, also closed well. Well, it was down. Where the Qs were up, the NASDAQ 100 was actually down slightly. And here are the Qs, which still continue to be positive. The NASDAQ 100 momentum is showing a real improvement and actually turning positive. Where the Qs were actually up a little bit, we're still above the 20 and 50 period moving averages here. So that's hanging in there for the time being. Small caps had a pretty good update, but we're just getting more to the higher end of the range. But we closed almost at the low for the session here. Again, not producing a lot of confidence in that move. Where the small caps for the Elders Impulse system are still positive. And with the Russell 2000, again, we closed down near the bottom. That's never a really, it may not mean anything, but look what happened back here right at the end of March. We saw this, and that kind of started this whole wave down. So we want to respect what we're seeing on the chart. But the RSI for the Russell 2000 small caps, that continues to go up. We're still above the 50-day moving average here. The long-term trend is still positive. And I say long-term, this is a 50 over a 200 period moving average. So it's really not long-term. But when you look at it on a daily basis, that's why I say long-term. And then I compare it with the momentum, which is more ultra short-term, and that is also positive. The mid-cap's also not a really good-looking bar here, but above its 50-day moving average. The mid-caps still are positive with the Elders Impulse system. Apple was up slightly, and it's still above its 200-day moving average, but it's still in an overall downtrend. Tesla was down 3.75%, coming back down to its 50-period moving average and also in a downtrend. NVIDIA was down 1.72%, but still above its 50-day moving average. Microsoft hit up at its 50-day moving average and then bounced down, was down a little bit more than 1%. Meta was up 0.5%, still trying to claw its way back after we saw this big gap lower. Amazon's probably looking about the best right now. I don't have Netflix that I look at for a chart. I'm just comparing this to the other stocks that I go in here. Where we closed off of the high here, but we're possibly making a short-term double top. We're coming back to previous all-time highs. We'll see if Amazon's able to break out above that. Google has been, after it came back down, it's finally starting to break out to the upside. It was up 1.87%. The FANG index actually declined a little over 0.5% after it's been pretty strong. It's still above its 50-day moving average, and it's still in an uptrend. The financial sector was up 1/3% and still above its 50-day moving average. And the staples to tech ratio, this actually ticked back up just a little bit. Not a big change. We want this to continue to decline if we're going to turn more positive. If this is declining, that means tech is outperforming staples. And the dollar did get back above 105, although it was down during the day. It went above 105 after hours. At least that's what I think happened. And then looking at the S&P and then comparing it with world indexes, we're still looking pretty strong in the short term. Not really seeing much of a change here in the longer term. With the total US stock ETF, we're still above the 50-day moving average, and we were up 0.11%. So we were down again slightly with the 10-year yield. We were up slightly with the 10-year based on price. We're coming right back up to the 50-day moving average based on price, where we had reclaimed the 200-day moving average. And we're still going down. I want to keep an eye on these to see if they're still showing some improvement. This is bonds to S&P. When this is going down, that means the S&P is outperforming. If we're going to turn more positive, we're going to want to see this ratio continue to decline. We're also going to want to see this ratio to decline between 1 to 3 month T-bills and 3 to 7 year bonds, where it had really been going up. And the S&P 1500 to shorter term bonds, this is continuing to break out a little bit above the rainbow. And the broad market is also breaking out above the rainbow when compared to 3 to 7 year bonds. We're continuing to decline with the 1 to 3 year versus the 3 to 7 year bond. After it had really been going up, we want to see this go down to be more interest rate and inflation friendly. And looking at a real improvement here, we're coming out of the rainbow. The market is still anticipating a soft landing when we compare the S&P to 3 to 7 year bonds. We're continuing to decline when we look at TIPS, which is what folks get into when they're worried about inflation, versus 7 to 10 year bonds. That's what they get into when they're more confident that interest rates have topped out. We want to see this continue to decline if interest rates are going to become more friendly to the environment. And then looking at the growth to value ratios, we were pretty much flat with the Qs to S&P. We're actually dropping below the moving average with discretionary to the S&P, turned down just a little bit, but above the moving average with large cap growth versus large cap value. So the large caps are looking better for right now. We're still under a declining moving average with the mid caps. We're above the moving average with the small caps, but the moving average is still declining. We continue to look better here with our 10-day average of the S&P 500 highs minus the lows, and we're not back up to an extreme reading, at least yet. We're positive with the advanced decline ratio based on 19 periods when we look at it based on price and volume. In broad market, the 5-period moving average of the highs minus the lows, they are still above zero. This is a little concerning, though. The S&P to utilities ratio continues to decline. We want to see this going up to give more support to the S&P. And we're continuing to decline here with staples to S&P. Actually, we have been declining. We ticked up a little bit in Tuesday's session. We want to see this continue to decline to be more positive. And then we did get a ZWAG NYSE breadth thrust, but it was too late for that. Maybe it's still good enough to really help out the market. So what's our outlook for Wednesday? We're still positive. We're still keeping an eye on that 50-day simple moving average. It was such a big deal after Friday. The fact that we're above it, if we start to see some selling, we want to see if that will provide support or if we're just going to slice right through that to the downside. We're going to get the MBNA mortgage applications index and wholesale inventories. Not really big in that category. Keeping an eye on the geopolitical events. Want to keep an eye on what's happening in Israel. And then we'll get weekly jobless claims on Thursday and consumer sentiment on Friday. We're going to get crude oil. I really don't track that. And there will be a 10-note auction in Wednesday's session. Sometimes that has no impact on the market. Sometimes it can actually have a big impact. Seasonality, we are positive with the Dow and the NASDAQ, where we're neutral to positive with the S&P for May 8th. We do see some positive seasonality here with the green dashed line for the 6th trading day of the month during an election year. Wednesday, though, tends to be the most negative day of the week. And I haven't had any updated versions of these charts yet. We're just trying to get back to the average. The takeaway from this is we do often see a trailing off of May during an election year, also confirmed by this chart put out by Stock Traders Almanac as well. And then I brought this up yesterday. I don't know if this is relevant or not, but we might be following what happened in 2012, where we see some weakness in May before we start to see a bounce when we actually enter into June. We also see some weakness here during May, according to this Carson chart. And then we're in that weak period, according to Tom Bowley's research, from the 6th through the 25th. Most of the month of May ends up being negative overall. So our warning signs, the equity put call ratio is going up. I don't know if that's a big deal or not. Sometimes the equity put call ratio seems to be influential. Other times it doesn't really seem to be telling us all that much that's helpful. And we're still negative with the NASDAQ 100 bullish percent index because we're below 50, but we are really improving with that. Positive signs, and I switched this around a little bit. Instead of just saying who's positive, these are all the things that are positive now. The oscillators, the McClellan oscillators for the S&P and NYSE, the Swenlin trading oscillator, parabolic SAR, bullish percent index, ultimate oscillator, chicken money flow, chicken oscillator, money flow, the vortex, the Copic curve, the NASDAQ 100 momentum as measured by the PPO and the financial sector. Maybe that's a little easier way to take all this in. All right, our conclusion. We are positive and we're still above that 50-day simple moving average. We're positive and we have a list. We don't know yet. Is it extreme positive and due for a pullback, or is this showing good momentum? If we do see a pullback, that's what we're really going to be watching to see. How is that pullback looking? And then in the intermediate term, we're just still pretty much positive across the board. Long term, we still continue to be positive as well. Thank you. I really hope you found this helpful. I hope you have a great day, and I will talk to you in the next video.